Jyothy Laboratories came out with numbers. Ullas Kamath, the joint MD of the company, now joins in. Hi, Mr. Kamath. Thanks very much for joining in. First, could you start by breaking up the 22% top-line growth for Q4 in terms of volume as well as price? And was there any value growth this quarter from the overall mix improvement?
Volume growth has been 15% and 8% was price hike and the value-wise growth. So overall is 22, and out of that 15 is volume and 7 is price.
Okay, fair enough. But sir, one of the dampeners in the results this time round has been a miss on the full year margin guidance. Your full year margin guidance has come in even lower than the lower end of your guidance of 14.5%. What led to the miss, and what is the outlook on the margins in FY15?
In fact, we have delivered, more or less whatever we have given the guidance. But you're right that one shade less from 14.5 to 13.3 is primarily because of the 1 percentage point, additional spend on advertisement and sales promotion, which was required during summer in the last quarter, which we spent a little more. And also, some of our products are really seasonal, like Margo in summer and mosquito repellent business. So we had to, spend the money on the brand, and we spend that. And if you see overall for the year, we have maintained our margins.
Good afternoon, sir. Could you tell us what the outlook is for margins in FY15?
Now that we are ready with products and the people and the management team and the organization structure, everything is in place, and I'm very, very confident of achieving 20 to 25% top line growth in the coming year as well, and having an EBITDA margin of 14%, being very conservative.
One of the investor concerns remains that in light of these new launches which are lined up for FY15, you may not be able to achieve such an aggressive margin guidance. How would you react to that?
In fact, we are not going for any big, new launches. Most of them are brand extensions, and they already have a base turnover. Like if you have Ujala extension, or you have Margo face wash coming in, or you are going for a relaunch in Henko, they all have base turnover, and we are spending only an incremental expenditure on advertisement, which also will moderate over a period of next 1 year. It is not that we just spend the money without having a business plan in place, but we are very, very clear in our mind that this has been done very nicely. It has come out beautifully in the last 1 year, and we are going with a lot of thinking behind the brand extensions, and I'm pretty confident that we might do much better than the guidance, but the least what we do is the guidance what we are given, and especially the team what I have, it's an amazing team, so I'm pretty confident about it. And also, it's a very low base of 1,300 crore, so cannot be really compared with big FMCG players, because we are a small base, and on a small base growing at 20-25% is doable.
Okay, Mr. Kamath, on the point of brand extensions which the company has lined up, especially on your brands like Margo, Henkel, etc., how much is the company looking to spend in absolute terms?
We'll be spending maybe 12 to 13% on advertisement overall for the next 1 year, and an absolute sum it should be between 140 to 160 crore for the year, and it will be spread across all the brands. And some of the mature brands we may not be spending as much as 10 to 12%. We might spend only 8% in the mature brand, but other brands will spend a little higher than the other ones. So overall, 12 to 13% on advertisement spend, and absolute sum 140 to 160 crore depending on the requirement in each quarter.
Okay, and now that the rupee has started trending upwards, how does that impact gross margins of the company? If
dollar stabilizes around 58, 59 is what we think for the whole year, we should get at least a percentage point or two maybe in our input cost. It should help us to improve our gross margin, and also we expect some efficiencies for internally, another 1 or 2 percentage point in internal efficiency in our manufacturing, because we are rationalizing our existing manufacturing facilities to get the best output. So overall, I'm confident that company as it is will take about 2 to 3% efficiency in supply chain and manufacturing, and also if a rupee strengthens, it will add to our kitty in spending a little more on advertisement. So overall looks very, very promising, the situation, and even the macroeconomics.
There is talk that the company is looking to monetize some of its assets, especially the land banks that you all own. Could you clarify if any land bank is on the block?
We have already put 3 properties on the block, and because of macro conditions not that great for real estate to sell, and we didn't want to be a desperate seller. And now that the situation is, feel good factor has come into the country, and hopefully we should be able to dispose of the land in the current year, and the value of that anywhere between maybe 100 to 150 crore. So we had kept it on the block, and if it goes in the current year.
Okay, so other than the recent restructuring of debt which the company has undertaken and plus the monetization that you spoke about, is there anything else which the company is doing to bring down its overall debt levels?
Monetization also is not on the top priority. For us, the top priority is building the business and getting to the internal accruals as much as possible. And as of now, there is no repayment of debt is going to happen till 2016 November, because the only debt what I have is non-convertible debentures, 0 coupon, payable in November 2016. So as such, there is no outflow of money till then, and to that extent we'll have enough free cash flow to build a business. At the same time, if at all, if I'm going for some inorganic expansion, probably I will be requiring some money, but not otherwise. So there is no compulsion on the company to dispose it off quickly and to pay the debt, because there is no repayment as of now.
Okay, fair enough. And what is the outlook on the fabric business now that it has turned EBITDA positive?
My laundry business, last 2 years our focus has been in Henkel acquisition, because stakes were high, and a lot of things we were doing in Jyothy. So now that it is completely settled, probably we'll be going in a moderate way in JFSL in the laundry business, in organic growth, and probably a couple of years you will see good results in that business. But as of now, in the last quarter, we are turned just above EBITDA, one shade above EBITDA positive, so we are happy about it. So business is on its own, but a big expansion might happen probably 1 year down the line. Otherwise, we'll just maintain the business.
So no plans to hive it off?
In fact, it is a completely separate entity as a subsidiary, and it's running on its own. And as of now, it continues to be the way how it is with us now.
Okay, one last question then. There is talk that the company is looking at some regional brands to explore inorganic growth opportunities. Would there be any truth to that?
No, in fact, been talking, but as you know that it's not that easy to get the business, especially the kind of business what we are looking at. And yes, like any other growing company, we keep always on our thinking of acquiring some regional brands and taking them national. But till such time we get one, we keep hunting for that. But our focus right now is completely on organic growth, and now that we have shown what we can do in the last year, but growing at 23% top line growth, current year our main focus will be on organic growth.
Okay, we leave it at that. Thanks so much for such a candid chat. So that's